Remember when people thought that email was just a fad? Or that Facebook was just for college kids? That's where we are with tokenization right now. Most people laugh it off, but the smart ones are learning about it before it goes mainstream. So let's start with a definition first. Tokenization is the process of taking real-world assets, something physical or even something intangible like music rights, and converting it into a digital token on the blockchain. That token represents ownership, or a slice of ownership that can be traded, verified, or transferred instantly without middlemen. So the next question is, what can be tokenized? The answer is just about everything. And we are going to break them all down in this video. Some of these ideas are hype, some are legit game changers. And part of what we do here in Crypto Safety School is help you spot the difference. I'll leave the link to our Crypto Safety School in the description of this video. You get access to the 8-class program, weekly live streams, crypto alerts from multiple analysts, whale trackers, news trackers, and more. So let's start with the thing that put tokenization on the map for most people: art and collectibles. Back in 2021, a digital artist named Beeple sold an NFT at Christie's auction house for $69 million. That moment was like a shockwave. Suddenly, people realized you could take a digital file, tokenize it, and sell it the same way you sell a painting or sculpture. At its best, tokenization solved a real problem for artists. For the first time, you could prove digital ownership. Anyone can screenshot a JPEG, just like anyone can take a picture of a painting, but only one person can hold the verified NFT on the blockchain. On top of that, NFTs can be coded so the artist gets a royalty every time their work is resold, something that never existed in the traditional art world. If a painting changes hands 100 times, the artist usually only gets paid once. With tokenized art, creators finally get to share in the upside. But here's the truth. A lot of it was pure hype. After Beeple's sale, thousands of random projects popped up. Profile picture collections, low-effort art, and straight-up scams. People rushed in thinking every NFT was going to make them rich, and most of these collections are now worth basically nothing. So what's the lesson here? Tokenization works best when it solves a real problem. In art, the real win was proof of ownership and royalties, not flipping cartoon monkeys for 10x gains. And collectibles go beyond digital art. Think about sports cars, comics, or memorabilia. Tokenization lets you own a verified share of a Michael Jordan rookie card or a rare Pokemon card without physically storing it or worrying about fakes. The blockchain becomes your proof of authenticity. So in this first example with art, we've got a mix of real utility, ownership, royalties, authenticity, and a ton of hype. Get-rich-quick schemes, speculative bubbles, and that's a theme we're going to see again and again as we explore other industries trying to hop into crypto. Lots of hype and hidden gems. Now let's move from digital art to something more tangible: luxury goods. Think about sneakers, watches, handbags, industries where counterfeiting and resale are massive. In fact, the global counterfeit luxury market is worth hundreds of billions of dollars. People buy Rolexes that aren't Rolexes, sneakers that look real but aren't, handbags that pass for the real deal on the surface. This is where tokenization comes in. By creating a digital twin of a physical product stored as an NFT on the blockchain, you can prove authenticity in a way that paper receipts or photos never could. And we're already seeing this in action. Nike bought RTFKT Studios and launched tokenized sneakers where you get both a physical shoe and a matching NFT. StockX experimented with Vault NFTs where the physical sneaker sits in a warehouse and the NFT represents your ownership. You can trade the NFT instantly without ever touching the shoe, and when you want the actual sneaker, you just redeem them. High-end brands like Prada and Gucci are also dabbling in blockchain-backed authentication for handbags and fashion. The benefits here are pretty clear. For consumers, your item is authentic and traceable. For brands, it protects reputation and reduces fakes. For resellers and investors, it adds transparency and liquidity to the secondary market. Of course, there's some hype too. Not everyone wants an NFT of their watch or handbag. Some people just want the product, period. and there's still friction in getting average buyers to care about blockchain verification. But make no mistake, luxury brands are testing this seriously, and they're doing it because tokenization solves a very real pain point in their industry, proving authenticity and adding trust to the resale market. Once crypto has more regulations and trust when it comes to the way the public views crypto overall, then this can really take off. Alright, let's talk about one of the most interesting corners of tokenization for investors and traders: stocks and equities. Here's the basic idea. Tokenized stocks are digital tokens on the blockchain that represent shares of a real company, like Apple, Tesla, or Amazon. In theory, each token is backed one-to-one by an actual share held in reserve somewhere. So if you own a Tesla token, you should be entitled to the same economic value as if you owned a Tesla share. So what's the big deal about tokenized stocks? Well, there's 24/7 trading. Traditional stock markets close at 4 p.m. Eastern or once after hours is over, and then shut down on the weekends. Tokenized stocks could trade 24/7, just like crypto. There's also global reach. Stocks on Wall Street are hard to access if you live outside the US, especially with fees. Tokenized versions could allow anyone with internet access to participate. And of course, instant settlements. Instead of waiting business days for your trade to settle, blockchain could make ownership transfers instant. We've already seen experiments. Binance and FTX, before it collapsed, both launched tokenized stock products in 2021. You could buy tokens linked to Tesla, Apple, Coinbase, and more. Small blockchain platforms still offer synthetic versions of popular stocks today. And BlackRock, one of the biggest asset managers in the world, is actively exploring tokenized funds and ETFs. They see tokenization as the next generation of financial infrastructure. So this isn't science fiction, it's actually happening. Kraken just launched X stocks using Backend, a Swiss fintech, in Europe. Investors in the EU can now trade tokenized US equities and ETFs via Kraken's app. Nasdaq has filed with the SEC to allow trading of tokenized versions of listed stocks and ETFs alongside traditional forms. Part of their plan, tokenized and traditional shares would follow the same execution settlement documentation rules as traditional shares. So tokenized shares aren't some second-class version, at least in their proposal. Robinhood has rolled out tokenized versions of over 200 US stocks and ETFs for European customers. This includes tokens that represent exposure to private companies like OpenAI and SpaceX through special purpose vehicles. However, these do not grant voting rights or actual equity ownership. See, there are still some things to watch out for. You might not always get the same rights as non-tokenized stocks. Many of these tokenized stocks or stock tokens do not carry shareholder rights like voting or access to company reports. Some are merely economic exposure. Regulation is still catching up. Even Nasdaq's own proposal shows how much must be aligned: settlement rules, custody, labeling, disclosure. If regulators don't approve, many of these things stay in pilot or limited rollout. Because many of these trade outside normal market hours or with low liquidity, sometimes tokenized versions trade at a premium or discount compared to the underlying actual stock. This is also a risk. And then there's dependence on backing and trust. So that means if the token says it's backed one-to-one by the real stock, you need trust in the custodian or the issuer. If that goes sideways, the token loses legitimacy, like with stablecoins, and we've seen what happens when stablecoins crash. And let's not forget, Wall Street makes billions of dollars on settlements, clearings, and brokerage fees. Tokenization threatens that entire system, so don't expect them to roll out the red carpet for this shift. Here's the exciting part. If tokenized stocks go mainstream, stocks start behaving more like crypto. Global, 24/7, fractional, and liquid. Imagine being able to hedge your Tesla position instantly on-chain. It could blur the line between the stock market and the crypto market entirely. But this is the key takeaway for Crypto Safety School. This is still an early stage. Right now, it's mostly experiments and pilot programs. Regulation needs to catch up before this becomes part of the mainstream investing world. So what am I watching next? Institutional adoption. BlackRock, Fidelity, and other giants are already exploring tokenized securities. When they move, the floodgates open. There's also global competition. Some countries like Switzerland, Singapore, UAE are way more open to tokenized stocks than the US. If the US drags its feet, innovation will just happen overseas first, and they don't want that. There's also retail adoption. Platforms that make tokenized stocks simple, safe, and legally compliant will win. Now let's talk about another corner of tokenization that's been getting a lot of buzz: music and royalties. For decades, one of the biggest problems in music has been how artists actually get paid. Streaming platforms pay out fractions of a penny per stream. Here, labels take massive cuts, and fans don't really have a way to invest in the music they love. Tokenization is trying to change that. Platforms like Royal.io, co-founded by DJ and producer Blau, let artists tokenize a portion of their song royalties. Fans can literally buy fractions of those royalties as NFTs. That means every time the song is streamed on Spotify or Apple Music, the fan who holds those NFTs get a cut of the revenue. Nas sold portions of 2 of his songs through Royal.io, and fans who bought in now earn royalties when those songs get played. Even Justin Bieber's track Company was sold this way, with fans able to share in the royalties. The idea is huge because fans become investors. Instead of just streaming their favorite artist's songs 1,000 times to show support, they can own a piece of the rights and share in the upside if the track blows up. But like with all tokenization stories, there are some challenges, such as small payouts. For most songs, the royalty checks are tiny. Unless it's a global hit, the money earned by NFT holders might be less than the gas fees they paid for it. There are also legal and IP hurdles. Music rights are insanely complicated. Publishers, producers, labels, performers all have stakes. Tokenizing royalties adds a new legal layer that isn't always so straightforward. And of course, adoption. Most fans still don't understand or trust NFTs or crypto wallets. For this to scale, the tech needs to get way simpler. So tokenizing music royalties is still experimental, but it's a glimpse of how blockchain could shake up the creative economy. Imagine a future where fans don't just stream music, they own a part of it. And again, it's the same theme. Tokenization has real potential, but it's still navigating legal, financial, and adoption hurdles before it can really take over. All right, let's wrap this up with a lightning round, because if it exists and it has value, someone probably is trying to tokenize it somewhere. So let's start with carbon credits. Some projects are putting carbon credits on the blockchain as NFTs so that companies or individuals can prove their eco-contributions. The idea is transparency. You can't fake a blockchain record. These can even be traded in open markets. There's also wine and whiskey barrels. Believe it or not, there are platforms tokenizing aging casks of wine and whiskey. Investors buy tokens that represent ownership of the barrel, then sell once it matures and gains value. This is turning luxury spirits into an asset class. There's cars and collectibles. We're talking Ferraris, Lamborghinis, even vintage baseball cards. Instead of one billionaire owning a classic Ferrari, thousands of people could own fractional tokens that represent a share of it. Same with high-value trading cards or memorabilia that gain value over time. And there's healthcare data. This one is wild. Some startups are exploring tokenizing patient data. Patients could opt in and earn tokens when their anonymized data is used in research. It's still early, but it's a new way to reward people for the value of their own data. And there's event tickets. Companies like Ticketmaster have been testing blockchain tickets to prevent counterfeiting and scalping. Instead of shady resale sites, every ticket is verifiable on-chain and can have built-in rules about resale. Then there's rare wine and spirits. There's a Brazilian winery that has done wine tokenization. Tokens are tied to an exclusive batch of bottles, giving buyers early tasting rights and benefits like hotel stays during tastings. Also, platforms like LCX tokenizes NFT versions of rare wine bottles, then bridges those into fungible access tokens so people can trade them on regulated exchanges. Imagine selling fancy wine bottles easily like we do with stocks and crypto. Economy is another example. They run tokenized wine collections, allowing fractional ownership of premium wine. There's also agricultural land and commodities. Some use cases involve tokenized farmland, so people can own fractions of agricultural land and share in crop yields or leasing income. Commodities like agricultural products, like coffee, cocoa, are being discussed in tokenization networks. It's early, but real conversations and pilot projects are there. There's luxury hotels, stadiums, and arenas. There are projects envisioning fractional ownership of luxury hotels or entertainment arenas, allowing investors to share in revenue from events, sponsorships, or occupancy. And of course, there are NFTs, which you know I love. There's VFriends from Gary Vee. Each NFT comes with access to VCon, a private annual business and marketing conference. Some specific tokens include one-on-one mentoring or dinners with Gary Vee himself. There's Bored Ape Yacht Club. Ownership doubles as a membership card with access to exclusive high-end parties, live events, and online communities. Holders have been invited to concerts with Eminem and Snoop Dogg, yacht parties, and collabs with brands like Adidas. Kings of Leon NFT album was the first major brand to release an album as an NFT. Special gold tickets included perks like front row concert seats for life. There was also Coachella NFT keys. Coachella released NFT lifetime passes that grant annual access to the festival plus special on-site perks. Some NFTs also included unique art and behind-the-scenes experiences. There's the Fly Fish Club as an NFT restaurant membership. It's the world's first NFT-backed private dining club in New York City. You need the NFT just to book a table. It's a tokenized membership to a real-world experience. Then there's Links DAO, an NFT community that bought a real golf course. Holders get governance rights, perks, and access to events and courses. The Gods NFT bought a basketball team and let their holders gain perks for the games. The point is simple. Tokenization isn't just about real estate, art, or stocks, it's spreading everywhere. From whiskey to healthcare to event tickets, if it has value, there's a project somewhere trying to tokenize it. So after running through all these examples, art, sneakers, stocks, music, whiskey barrels, you might be thinking, okay, but how much of this is actually real? And that's the key question. Because tokenization is one of those ideas that sounds like it could fix everything, but the truth is it's not that easy. Here's what's real. Tokenization works best when there's already a clear pain point. In art, it's solved ownership proof and royalties. In luxury goods, it's fighting counterfeits. In real estate, it's lowering the barrier to entry. And in finance, it could make stocks trade faster and more globally. Here's what's hype. Projects that just slap NFT or tokenize on something without adding real value. Over promises that ignore the legal side, like calling an NFT a deed when no court would recognize it. And speculative bubbles where the token itself becomes the product, instead of representing something meaningful. At the end of the day, tokenization is a tool. The tech itself is neutral. It's how people use it that matters. If it solves real problems, it sticks. If it's just hype, it fades. And one more thing to keep in mind. Regulation is the deciding factor. Until governments create clear frameworks, a lot of these ideas will stay experimental. But once regulation catches up, especially with big players like BlackRock and institutions pushing forward, the shift could accelerate fast. Tokenization is not just hype, and it isn't just magic. It's a gradual evolution that's already reshaping how we think about ownership, and it's only going to spread. This isn't just about monkey pictures, we're seeing it expand into art, sneakers, stocks, music, whiskey barrels, and even carbon credits. Some of it is just hype, some of it is real, but the direction of travel is clear. Crypto is slowly rewriting what ownership looks like, and the people who understand this early, they won't be the ones left behind when the shift hits mainstream. That's exactly why we have our Crypto Safety School. The goal here isn't just to explain cool use cases, it's to prepare you so that when tokenization, stablecoins, or whatever the next wave of crypto adoption hits, you're not scrambling to catch up and you know how to do it all safely. Think about it. When email came out, when Facebook launched, when smartphones took over, there were always people who said, "That's not for me." And years later, they had to learn it anyways, usually from behind. I don't want that to be you when it comes to crypto. I'll leave the link to our Crypto Safety School in the description of this video. You get access to the 8-class program, weekly live streams, crypto alerts from multiple analysts, whale trackers, news trackers, and more.